Should you take Social Security early because interest rates are so high? A lot of people come to me to talk about when they should take Social Security, and we run through formulas and we do math. We talk about the situation. And one of the key points that people try to make when they're justifying claiming Social Security early is that give me the money now and I can invest it myself and do better than the government has. And that case is getting stronger and stronger now that interest rates are so high. Let me bring in my co-host, Tony Shore. Tony, welcome to the show. Yeah, taking Social Security early because you can invest the money better at a higher rate. Have you
I
heard that
know a
one
lot of
before?
people I know a lot of people who say that and think that way. Yep.
So the idea is the math and the strategy of delaying Social Security actually gets worse as interest rates go up. And interest rates have been going up in 2023 pretty
Right.
dramatically. And the case to delay Social Security has been going down dramatically as well.
But
Believe it or
that's
not.
at this moment in time. I mean, the problem is delaying Social Security is a permanent thing. Once you file for Social Security, it's done. You've locked in that lower amount. And if next year by 2024 we're looking at 0% interest again, and it stays at 0% the rest of your life, was it still a good idea to delay taking or to take it early?
Well, that's the question. That's what we're going to answer today. And there's
That's
actually some research on
that's
this.
what I'm asking you.
There's some research on this. So what we have to first determine is if the real rate of return is higher than what Social Security is offering by delaying. I mean, if you could get a real rate of return higher than what Social Security is offering, why wouldn't you delay? Why would you delay? I'm saying, why would you delay? Just take it now and invest it and get the difference. And that's really the crux of it, isn't it? But notice I put real in capitals because there's a difference between the rate of return and the real rate of return. And I
Yeah.
just want to explain that to the viewers and listeners. Real rate of return factors in inflation. And there's a formula, which I'm not going to get into because I don't want to put Tony to sleep or make him sweat. So, but basically, you take whatever the interest rate is and you factor in inflation. So it's not this simple, but very close idea would be if you're getting a 7% return and inflation is 4%, your real rate of return is 3 because you got 7% return, you got to factor in inflation. So your real rate of return is less because you factor in inflation. So if you get a real rate of return higher than what Social Security is offering, then why would you ever delay? Why not take it? Right? Um, but the question is, well, what's the real rate of return? What can you get? And what rate of return do you use to make all these calculations? Because like you said, yeah, they're right. The rates of return are pretty good right now, but what are they going to be in a year or 5 or 10 or 30? So a lot of people in my industry, financial planning, when we're looking at this, we default to using TIPS, Treasury, inflation, and protected securities, because that's about as close to we're going to be able to get as a long-term measure of the real rate of return. Notice they're U.S. Treasuries, and you can go 30 years on this. So you can get a 30-year Treasury that you lock in the rate, but that rate changes based on inflation. So if inflation goes up, the rate goes up. If inflation goes down, the rate goes down. So that's as close to we can get as a real rate of return for a long time. And it's pretty steady because it's backed by the U.S. government. So that's the rate of return that a lot of people use from a financial perspective if they're trying to be risk-free or as close to risk-free as they can be. You have any idea what the 30-year Treasury tip, the 30-year tips are right now, Tony? Would you
I do
guess what
not.
they are?
I do not. I have no
And we're
idea.
we're we're looking at September of 2023, roughly around 2%.
Oh wow. I would
2%
have
for the
thought they would have been
30-year.
high. I would have guessed 3 to 5, but no, they're only at 2, huh?
Yeah, you can get a 1 year and it's probably close to over 4.
Right.
But
Right.
again, what does that get you when we're talking about a lifetime income?
Right.
Are you going to only live for a year? Then take it today, right? But we're looking at 30 years. Yeah, you're only and that's the real rate of return because it's factoring in inflation, and that return will go up as inflation goes up, and it'll go down, and it could be negative. So you can have a negative tip return, right? Because inflation could be more than the actual interest, which is where we were just a year ago, weren't
Yeah.
we?
Yeah. I was just
So,
going to say that sounds an awful lot like 2022.
so if you're looking at this, which is what I tend to do and say, well, Tips is offering 2, um, then why would I ever delay? So why would I take Social Security now? If I can only get
Right.
2, Social Security is
Right.
giving me 6, 7, 8% return, depending on delayed retirement credits after full retirement age are 8%. Like, it's not even close, right? So there is some research on this. Because what people say then is, well, what if I don't invest in Tips? I'm not a grandpa. I'm not,
Yeah.
I'm not scared. I'm not scared of the stock market. I can get 8% on average. I can get 10% on some of these real estate funds that I got. You know, William Devane is telling me I can get a 12% return on if I buy gold. Tom Selleck saying I can get 15% if I reverse mortgage. So
No,
so the
no,
question is,
no, no. That was Tom Selleck's mustache that's saying that,
yes,
not Tom himself.
so
That's just the
yeah, we just
mustache.
talked about that in the last show, in case anyone's
I
wondering
know.
where that came from. Um, so there are people that will say, well, I'm not going to invest in Tips. I'm going to invest in the market. I'm going to hold for the long term. So why can't I show an 8%, 9% return? Seems reasonable to me. And as a financial planner, I agree because that does seem reasonable. But when it comes to what the purpose of Social Security is, maybe not. But I want to show you this. This is a study from 2016. It's called Discount Rate Specification and the Social Security Claiming Decision. All right. And this is on SSA.gov. So the link is below for those viewing on
So this is
YouTube.
on the
And
official Social Security website, ssa.gov.
yes, yes. And there's the document link right there. And it goes into this question of, well, what's the optimal claiming strategy? Like what age? And let's do math. And he does the math. And he goes into high levels of detail. And I'm going to sum it up with a conclusion statement. In the conclusion from that study, it says claiming at age 62 is optimal at discount rates of 3.8% or higher for men and 4.6% or higher for women. What that means is if you can get a real rate of return of 3.8 or higher for a man, you should claim Social Security at 62. It makes no sense to delay if you can get a real rate of return at 3.8 or higher.
Wow.
So right away, it's like, well, I mean, 3.8 is not that great. I thought it was 8% or something like that. Again, this is a real rate of, this is a discount rate. I don't know the exact number, but I'm pretty sure that when Social Security, they added delayed retirement credits and they were the actuaries, I think they used 2.9 or 3% as the discount rate when the actuaries at Social Security were doing it, real rate of return. So again, we haven't been there for the past decade. We've not even been close, but now we're getting closer to the point where you could say, yeah, I can get a real rate of return of 3.8. I think I could do that. Yeah, I might have to invest in stocks. But this is something that people are starting to say, maybe I should be claiming at 62. Why am I waiting? Right. But like you said, will the rates remain high? Can
I
you
have a
lock
feeling
in?
they won't. The Fed is doing everything they can to get the inflation down so then the rates can come back down, right?
Right. But if inflation goes down, then the real rates of return theoretically go up
Yeah,
because,
that's true. Well,
if
that's
I'm
true.
getting
Yeah.
right. Um, but can you lock in a real rate of return at that level for so long? Because you don't need Social Security is not going to last you a couple of years. If you're going to delay or take it at 62, if the decision to take it at 62 is to hope that you're going to beat the Social Security return over the next 30 years, then you need a 30-year rate. You can't lie. So, but then again, that's what people say. Well, if I got 30 years, I can ride the stock market wave and I'll be fine.
But you don't
But
know
then
you have 30 years.
you don't know, right? And this is all based on the average life expectancy. So this is all based on the average life expectancy. If you're going to live past, the 82 or whatever the average is, that throws all this math out the window because they have to pick an age. And we'll get to that in a minute. But the other question is not only will you be able to get that rate of return consistently, is will you invest and save the difference? So the idea is I'm going to take it, and then the difference between what I would have gotten if I waited, if I take that and invest it, then by the time I'm 75 or 80, it'll be there in a much bigger number and more liquid, right?
I can count on one hand the number of people out there who would actually end up doing that. And I don't even need all 5 digits. And there are millions of people out there, but yet I can count that, maybe 4 people. And I mean, one out of every 100 person, if that, one out of every 10,000 people might be able to do that. I don't think people are disciplined enough to do that.
Are you suggesting that there's a lack of delayed gratification in this country?
Oh, I would never say such a thing. Of course there is. You know the answer to that.
So, but again, what do you think that I'm suggesting overall, based on what we've said so far? Do you think I'm telling people take it at 62?
I think your answer would be, I think you would be smart enough to probably hedge your bets and say it depends. You want to talk to them personally?
Yes, you got it, Tony. That's going to be my answer. It depends, because
Yeah.
I'm not gonna say that this doesn't make you wonder. Hey, obviously there's more to it than math. If you're going to live to age 100, but if you're going to get a real rate of return in this same study in there, it says if you're going to get a real rate of return of 7.5% or more, it doesn't make any sense to not claim it at 62. Even if you live to 120, you would have been better
Wow.
off claiming at 62 if you can get 7.5 real rate of return.
And if
Now,
you
if
reinvest the money.
If you reinvest the money and have the discipline to do that. But also, even if you spend the money because of the time value of the money, you spend it now, it's worth more now than it is 20 years from now, that same amount. So, but here's another example. Here's a scenario, Tony, where I think even if you said, hey, I'm going to live to 100, and I don't think I can get a real rate of return very high. How about this? What if you said I'm only going to get 3%? So odds are, I'm not going to be able to beat it. So I might as well wait and delay Social Security. What if you claim Social Security early at 62 and use those payments to pay off high interest debt? Let's say you got a credit card or even a home loan, a mortgage, right? What are mortgage rates in September of 2023 right now? They're above 7% now.
Yep.
So if you have a debt at 7% or 8% that you're just paying on and paying on, but you could take Social Security and pay down that debt, what you're fundamentally getting is a rate of return of 7%, because that's what the mortgage is. So you're paying off. You're not only are you not, it's not the income that's 7%, it's the outflow that is not 7%, which is the same thing. If you're looking at it from cash in your hand, I'm not paying out 7% over here, or I'm getting 7% over here. It's the same if you're just looking at it from that perspective. So doesn't that mean you should claim Social Security at 62 if you have high interest debt? This
That
is the
makes
case.
sense. Yeah.
And mortgage rates over 7 now. It's like, if I'm going to get a mortgage in retirement, which we've done shows on, should you have a mortgage in retirement? Some people do. Watch that show if you're wondering if you should. But if you do, maybe claiming Social Security makes financial sense because your interest rate's so high. The same case could be made. Do I take a loan against my 401k to pay off credit card debt? What are you doing there? You're dancing on a very fine line of paying down debt using your future retirement funds, which can make financial sense if you look at it from a math perspective. But what if you just go right back into debt? What if you don't
Yeah.
change your ways? And then what you fundamentally did is dug the hole deeper. We did a whole show on that, paying down debt using a 401k loan. Um, I don't even know if that's been years since we did that show, but I remember doing it. So
Yeah,
you
I do
see,
too.
there is a case to be made here that claiming it as soon as possible to if you can get a real rate of return that's above 3.8 for a man. Didn't think that was going to be discussed today, did you?
No,
But
no. You always surprise me at the angle you take and the view of a topic you take. You always try to turn it around and look at it from another side, another angle. I like that.
I can make the case. I can make the case that you could take it at 62 and be okay and be a smart decision. It's just dependent on the situation. But I can also make the case, which I'm going to go right now, that you should delay because you got to remember what's the main purpose of Social Security. It's supposed to be a lifetime income.
Yep.
And it's really, if you look at really the true purpose of it, it's longevity insurance. It's going to be there for you or your spouse. Now, remember, adding a spouse to the mix changes when you should claim because it's not just your life, it's your spouse's life too. If you delay to 70, you got a higher amount. Yeah, it may not make actual sense on your life because you're not going to live to past 82. But what if your wife does or your husband and they get that higher amount? All of a sudden, it's joint life that you got to look at. So it changes the math. But you got to remember, Social Security is for longevity insurance. If you're going to live a long life, wouldn't you want Social Security to be high? Wouldn't you want it backed by the U.S. government? Wouldn't you want it tax advantage because not all of it's taxable, right? Don't you love that cost of living adjustment on a bigger number? Are you going to be able to replicate that with your own private investment to get that return taxed advantage plus cost of living? No. So it's not that easy to get a return that beats Social Security. Certainly wasn't the case in the past 20 years, but now it's starting to become a little bit more realistic to have that conversation about maybe I can, but just don't forget it's for the future, long term.
Yeah. Yeah, you got to be looking down the road and you have to do the math, right? It's the bottom line.
Exactly. So, conclusion, you can make the case that Social Security early is the smartest decision. We've done shows why you should claim Social Security early at 62. We've done a whole show on that. There's a lot of reasons. We didn't ever mention that you can get a better return because it wasn't realistic at the time. But now it's starting to be a little bit more realistic to actually get a real rate of return that's better than or equal to Social Security. So you can make this case if you invest the difference, but you need significant discipline, as you stated. You know, not many
Yep.
have it. But I would caution you, even when you do all this thought, don't forget about longevity for you. And if you're married, your spouse.
Good show. And our listeners should not do any of this, any planning or file without working with somebody like yourself, a financial advisor, to help them through
Yeah.
this and to help them do the math and run the numbers, right?
Yeah, I use a calculator. I have software that maps all this stuff out. You could change the rate of return and it gives you an idea. There's a lot of free tools out there. Go ahead and use them. Don't try and do it in your head. Like the other day, my one of my kids needed help with his math. He's doing geometry. And it's like you got to measure the volume of the cone, three-dimensional cone. I'm like, I have no idea how to do this. But give me the formula and I could use a calculator to figure it out. The Social Security formula is so complex. There's so many moving parts here that if you just try and do back of the napkin math, it's a little bit risky. And you always remember what's at stake here. Like you said at the very beginning, Tony, you're so accurate about this. It's a lifetime decision. You can't undo. You could undo it within a year, but you can't undo your Social Security decision. So
No.
if you're going to just take it at 62 because the math makes sense because you can get a 5.5% fixed annuity for the next 5 years. What if 5 years? What are we going to be? Where are we going to
Yeah.
be?
Yeah.
And you can't go back and say, darn it, I should have listened to Tony. Well, you're never going to say that, but anyway.
Said no one ever, I think. Yeah. You might say, I should have listened to Dan. That's what they'll say, yeah.
You're right. So, Tony, again, thanks for dealing with yet another Social Security show, but it's so important that people do it. I urge people, if you're thinking about this, go to dolphinfinancialgroup.com and connect with us. We'll do the Social Security maximization report for you, which shows all the scenarios, and then we can have the conversation about alternatives to taking it early and getting a better rate of return. Totally within the wheelhouse of what we do. Be happy to help you. Just let us know. Tony, thanks for a good show. We'll see everyone next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.